All right, so we're going to dive into how to buy a home part two. And I wanted to title this, How Much of a Home Can You Actually Afford? And there's a big difference between what the bank will approve you for and what you can qualify for versus what's a smart financial decision. What should you actually buy? And so let's dive right in. I want to go straight into this and start talking about how lenders calculate income. And so the first thing that we're going to look at is for W 2 employees. It's a little bit different, right? The bank is going to use the gross income. So for your base salary, overtime income, bonus income, commission, all of that, we're going to use the gross pay before taxes get taken out to help with qualification. So if somebody's making $6,000 a month, but you're only making $4,000 after tax to your bank account, the bank will actually let us use the $6,000 or the gross number to help with qualifying for the income. Okay. The other thing with overtime, bonus, commission, tip income, other style line item pays, we can use those for qualifying, but the bank sees this as more of what's called variable income. And they're usually going to want to see somewhere in that range of 1 to 2 years of history to be able to use this income. So 12 to 24 months. And they also want to see that it's trend lining stable or increasing. If it's going down year over year, that could cause a little bit of a hiccup, right? So we want to look at that. So key with W 2 employees, whether you're full time, part time, we're going to use gross income. Now, if you are part time, good thing to note is that, again, the bank wants to see stability. And so sometimes you get to be 12 months to 24 months on the job for part time income. Now let's move into self-employment. So business owners, sole proprietors, 1099 employees. You're not an actual employee of a company. You're a sole proprietor, contractor, or a business owner. And so with this, it's very important. And I actually tell all of my clients that are self-employed to plan well in advance, because for a standard conventional FHA or standard best style interest rate loans, the bank is going to go off the last 1 or 2 years of filed income tax returns to use for qualification. So that's number one. And then number two, they're also going to use the net income after expenses are written off, not the gross income. So, okay, it's a little bit different than the W 2 employee. If you look at a business owner, if you're making $100,000 a year as a business owner and you have $50,000 of expenses, so you write off $50,000 in expenses, the bank's only going to let us use $50,000 as far as qualifying income, not the $100,000 for a standard conventional or an FHA loan or jumbo loan. They're going to use that. And then in addition, if your business has been owned for less than 5 years in existence, a lot of times they're going to make us take a 2 year average. So for example, I'm recording this in 2025. If somebody were to file a lot more income in 2024, but then in 2023 they had a lot less income, the bank may make us use a 2 year average of both of those too. So it's super critical, super important that you meet with a lender well in advance, 1 or 2 years prior to buying the home, and you have a great CPA to help you with tax planning to go through this. And so if you have any questions on this, if you're a business owner, it's really good to set up a one-on-one call to go through this in more detail. Now, there are some creative solutions around this. We do have bank statement loan style, P&L style loans where, for example, on a bank statement loan, the bank will use all of the qualifying deposits on your bank statements for the last running 12 months. So we can use the deposit income, not the after expense income. And then they're going to use an automatic expense ratio factor anywhere from 20% to 50% of your deposits as an expense factor. So if you've got $300,000 in deposits from your business, the bank will let us use, 150K, maybe 200K, maybe $225,000 of deposits without even having to show your tax returns. And we can use a running 12 months of business bank statements. So that's another creative product that we have for our self-employed clients that we work with. Now, the other sources of income, we have child support and alimony. If you're receiving that, we can use that with court order documents. Rental income, we can use rental income to help with qualification as well if you own rental properties. That has to be filed on your tax returns though, and this is something, again, you need a consultation to see how does that work out for you in your situation. Social Security, retirement, pension, trust income, anything in that manner, we can use that as it's considered stable income. Trust income is a little bit more of a caveat. A lot of times you need more of a history, but for retirement income, Social Security, and pension, it is something that can be used for qualification, whether you're maybe a cosigner, co-signing for a loan, or if you are a full, normal borrower that's buying a property, we can use the retirement income. The other thing that's a little bit creative is asset-based loans. We can use asset utilization or asset depletion to help qualify. So if somebody has $1 million in a retirement account and they want to borrow a loan for 500,000, we can actually use those assets to help qualify for the loan without even needing to show any tax returns and things like that. So there are some creative stuff there. Lastly, on the investment property, if somebody's owning a property, wants to buy in an LLC, they want to buy a full-blown investment property, we can do something called a DSCR loan, which stands for Debt Service Coverage Ratio. What this is the bank's letting us use the rental income on the appraisal to help offset the monthly mortgage. So for example, if you buy an investment property and the monthly payment is $4,000 a month with taxes and insurance and HOA included, if the rent comes in at $4,000 a month on the appraisal report, that's a 1-to-1 ratio, the bank will approve the loan, right? If the rental income comes in at $5,000, the payment's $4,000, well, that's over a 1% ratio. That's even better. But let's go on the other side. If we go and let's say the rent comes in at $3,000 a month, but there's a $4,000 a month carry of a monthly payment, that's a 0.75 ratio. We can still do the loan, but there could be some pricing implications for a higher interest rate. So that's a creative investment property loan where you don't actually have to show any tax returns to qualify. We can use the collateral of the property and the proposed rental income to help with qualifying as well. So here's my pro tip for this section. Meet with the lender at least 3 to 4 months in advance. And if you're self-employed, I would do 1 to 2 years. It just gives you time to plan through this accordingly. So let's go through qualifying versus affordability. Qualifying is what the bank wants. Affordability is what you should actually buy. And so the bank on the qualifying side is going to go off something called DTI, or debt to income ratio. And so what DTI means is what is the percentage basis of your expenses with the new property plus any debts divided by your qualifying income. So for example, if a new home payment costs $4,000 a month and your monthly income is $8,000 a month, and let's just assume there's no debts in your name. You don't have any cars, credit cards, student loans, anything like that. We just have $4,000 for the new home payment, $8,000 a month of qualifying borrower income. That's 50% debt to income ratio. That's a qualified loan in the eyes of the bank, right? Now let's say that you have $4,000 a month for the payment, but then you also have $1,000 a month car payment, right? Now you're at $5,000 a month over $8,000 a month of income. Now we don't qualify because we're above that 50% threshold. So this is, again, how banks calculate. There's a lot of different ways to go through this. This is just for example purposes. Now let's go on the other side. What can you actually afford? We'll take that same scenario, right? The standard usually is that you shouldn't spend more than 25 to 40% of your net take-home pay for a housing expense. And this is, all over mainstream media and different social media outlets. I've seen this stat all over the place. Point I want to get at is that your financial fingerprint is different than anybody else's, and your risk tolerance could be different than anybody else's. This is just a rule of thumb for that 25 to 40% range. I've had some clients that are at 50% and they made a smart financial decision. I've had other ones that shouldn't go more than 20%. The key is finding what works for you, but this is a good rule of thumb. And so when we go back to that scenario, if a new home payment is $4,000 a month for everything, with taxes, insurance, and everything, that would mean that you should be making anywhere from $10,000 to $16,000 a month in net take-home income to stay within that 25 to 40% threshold for a smart financial decision, right? So again, I don't want to say on this video that you should follow this exact template. This is just more of a rule of thumb. You need to meet with a professional to be able to look at your full debt load, what your income expectations are over the next 1, 3, or 5 years to figure out how much a home you should actually afford. But I hope this helps give you a little bit more of a rule of thumb for it. But here's the pro tip I'd give you on this slide is that review your expenses, right? Sometimes people can actually afford a lot more than they think they can. You just want to go through and see, is there anything I can eliminate? Is there any expenses I can reduce? What am I paying right now? What's coming out of my bank account? A lot of times we're just going about our lives and we're getting paid and we're not looking at what's coming in and what's going out. And maybe you're spending $300 or $400 a month on Uber Eats right now, and you could cut that back a little bit because it would be going towards something with more purpose to fulfill your life and your financial goals a lot better, right? Maybe it's that you can sell your car and downsize your car. Maybe it's cutting out some credit cards. Maybe it's borrowing with some family money that you can work through inheritance to help consolidate debt, to free up cash flow, to be able to buy a home. All these things are just creative things that you need to be looking into to help make homeownership more affordable. So the last thing is determining your comfort zone. So just because you qualify does not mean you should actually take on that payment. So here's my advice as far as what you should be going through as far as tips. So number one is start with what's the monthly payment that you feel like you should be at based off everything you learned in this video. That's the first step. Number two is determine how much money you can put down or would want to put down, or maybe you have family that can gift you money. Figure out how much capital can go into this purchase, right? Is it 3% down, 5% down, 20%, 50%? If you have a ceiling of how much capital you can come up with for a down payment and how much of a monthly payment you can go up to, then we can reverse engineer the numbers. And that's step three, which is work backwards into the right home price range. And this is where you need a lending professional and a real estate advisor to help you figure this out. But when we have steps 1 and 2 figured out, it's a whole lot easier. And number 4, and this is, I kind of say this jokingly, but this is a very serious question I ask a lot of clients, and I call this the will I sleep good at night conversation. And the question is that if you're to buy this home, and if your payment were to be X, let's say it's $4,000 a month, would you be able to sleep good at night with your head on the pillow in your new home? Are you going to be happy? Are you going to be satisfied? Are you going to feel comfortable? Or are you going to feel maybe you bought a little too much home, and while it's a nice home, you're actually more stressed than where you were before, right? I'm not big into rent shaming. I'm big into helping clients make a smart financial decision when you're going into home ownership. And so, for example, if you're comfortable with $4,000 a month and you can do 5 to 10% down, well, that may translate to you buying a $450,000 to $550,000 home, right? Obviously, there's a lot of factors that goes into that, but that's a good kind of rule of thumb. And so here's the pro tip for affordability hack. If you look at the bottom of the screen here, every $10,000 you borrow is going to move your monthly payment somewhere around $60 to $65 a month. So if you borrow 10 grand on a mortgage, or if you put down an extra 10 grand, it's going to move your payment about 60 to 65 bucks a month. Not a whole lot, right? Well, the reality is because it's on a 30-year mortgage amortization, and so sometimes you don't actually have to save as much as you think to become a homeowner. Every $50,000 is going to move your payment $300 to $400 a month, and then every $100,000 you put down on a home, it's going to save you somewhere around $600 to $700 a month. And what's funny about this is that a lot of people's car payments are costing them $100,000, maybe up to $200,000 home buying power, and they don't even realize it. And so I like to use this for a budgeting perspective to help you understand how money works on a mortgage, because it can really help you with the affordability and the home buying power. So I hope this was helpful. This is just part 2. We've got many more parts coming along, so strap in. I'll be sending more videos out over the coming weeks and months to help finish this How to Buy a Home series. But I hope this was helpful to understand how banks qualify income and calculate income, and also how much should you be able to buy? What can you afford? If you want to get started, feel free to click the links below or scan the QR codes, set up a discovery call, or go ahead and apply online, and we'd love to get your pre-approval process started. Have an amazing day.